Today we discuss about accounts receivable. Accounts receivable is a common term used in accounting to describe the amount of money that a business owed by its customers for goods or services that have been sold but not yet paid for. Okay, simply we understand accounts receivable as it is a amount receivable from the customers. Who are the customers? The, if the company sold goods or rendered services to customers, then we have to receive money from customers because the goods or services rendered on credit basis. So it is a simple understanding of accounts receivable. Now we go for theory. Accounts receivable is a common term used in accounting to describe the amount of money that a business owed by its customers for goods or services that have been sold but not yet paid for. AR is considered as a current asset. Why AR is current asset? Because customers owed money to the business. We have to receive that amount in the current year. So as the funds are expected to be collected within a year, so the debtors are collected within a year. Next we go for meaning. Accounts receivable trade refers to the money owed to business by its customers for goods or services sold on a credit basis. Okay, trade accounts receivable are typically short-term assets as they are expected to be collected within a year. Okay, so these are all we have discussed. So simply accounts receivable is a money owed to business by its customers for goods or services sold on credit. Okay, now we go for entries. When a business sells goods or services on a credit, it records the transactions as an increase in accounts receivable. Okay, increase in accounts receivable means increase in debtors. Okay, so this is the inner meaning of accounts receivable. So increase in accounts receivable means we have to receive amount from the debtors, that's why it's called accounts receivable. The journal entry to record the sale on credit is as follows: debit accounts receivable account, credit sales revenue account. We know the golden rules of accounting. So we have to debit accounts receivable, it's a current asset. Credit sales revenue, it is a revenue account, we have to credit. Okay, when the customer makes the payment, the business record it as a decrease in accounts receivable and an increase in cash. Okay, I hope you understand. So at the time of sale on credit, debit accounts receivable, credit sales revenue. At the time of receipt amount from the customer, we have to reverse. So now we have to credit accounts receivable. What we have received now? Cash. So that's why as a real account rule, we have to debit cash account, credit accounts receivable account. Now the current asset decreases. At the time of sale, we have debit accounts receivable. Now we have credit accounts receivable account. Okay, next, reversal entries. Do you know the meaning of reversal? When we will reverse the entries, do you know that? I hope you understand. I already covered in the concept reversal. Okay, if a sale is made on credit, but it is later determined that the customer will not pay, the business may need to reverse this initial journal entry. So at the time of sale, we have debited accounts receivable account. Okay, so at this point of time the customer will not pay, so that's why we have to make reversal. Okay, we need to reverse the initial journal entry. The journal entry to reverse the initial entry is as follows. So what is the entry? Simply just reversal: debit sales revenue account, credit accounts receivable account. Okay, debit sales revenue account, credit accounts receivable account. So other concepts related to accounts receivable are, so there are few other concepts related to accounts receivable that are important to understand. Okay, what is the first concept? Bad debt expense. So in related to accounts receivable, bad debt expenses, if a business determines that a customer will not pay, it may need to write off the amount owed as a bad debt expense. This reduces the value of accounts receivable in the balance sheet. Okay, for example, the company sold goods for 1 lakh rupees. So what is the entry? On credit basis. Okay, what is the entry? Accounts receivable account, debit to sales account. Okay, so at one point of time we assumed, so we recognize that the customer will not pay up to 20,000 rupees. Then we recognize as the 20,000 is a bad debt. Okay, so this is the inner meaning of bad debt expense. So then we have to reduce the value of accounts receivable on the balance sheet side. So what is the amount of accounts receivable? 1 lakh rupees. Now we have to reduce bad debt expense to the extent of 20,000 rupees because it is not recoverable from the customer. Okay, next, second concept, factoring. Some businesses may choose to sell their accounts receivable to a third party known as factor. The factor pays the business a percentage of the value of the accounts receivable upfront and then collect the money owed from the customers. Okay, factoring, simple example. For example, our company has a 10 crore accounts receivable. We need to collect from the multiple customers. Now we go for third party, called as factor. The factor duty is he has to collect accounts receivable behalf of company, the 10 crores. Okay, the factor charge some commission for that collection of debtors. Okay, different type of factors are there. We are discussed in a separate class. Okay, so this is the inner meaning of factoring. So factor are collected accounts receivable behalf of company, they will charge some commission. Okay, next, amortization. Some businesses may choose to amortize their accounts receivable over time, which means they recognize a portion of the revenue each period instead of all at once. This can help smooth out fluctuations in revenue and provide a more accurate picture of the business financial performance. In present corporate companies, revenue, that means accounts receivable, we have to amortization every month. Okay, so this is the amortization for simple understanding. So amortization means recognize the accounts receivable over time, that means month on month basis, based upon how much revenue recognized each month. For example, we have accounts receivable 1 lakh. Okay, actually we have earned this accounts receivable for monthly 20,000. Now we have to recognize per month basis 20,000. Okay. We will go with the example for better understanding. Amortization of accounts receivable is a process of recognizing a portion of the revenue each period instead of all at once. So in our example 1 lakh, okay, we have to amortization revenue each period instead of all at once. This is typically done using the straight line method, which involves dividing the total amount of accounts receivable by the number of periods over which it will be amortized. Okay, the resulting amount is recognized as revenue each period. The purpose of amortization is to provide a more accurate picture of the business financial performance over time and to smooth out fluctuations in revenue. Okay, in our example 1 lakh is the accounts receivable. So we recognized the 1 lakh is applicable to 5 months. Okay, so immediately we have not recognized that 1 lakh. So total accounts receivable amount by how many months? 5 months. So per month 20,000. We have to recognize amortization monthly 20,000 rupees up to 5 months. Okay, like that we have to amortization. Okay, so this is the accounts receivable. So I hope you understand. So simply accounts receivable is a trade refers to the money owed to a business by its customers for goods or services sold on credit basis. Subscribe and share. Thank you.